Hello everyone. Welcome to Net Diligence Virtual Cyber Risk Summit. My name is Heather Osborne and I'm the Director of Global Events and Programming at Net Diligence, a cyber risk assessment and data breach services company. Net Diligence is pleased to bring our thought-leading content to the virtual space with this new webinar series. Visit our website at www.netdiligence.com to get more information about our upcoming webinars and in-person events. Before we begin, I'd like to extend our heartfelt gratitude to our virtual Cyber Risk Summit sponsors, particularly Aspen Insurance, our diamond sponsor. I'd also like to thank our 100-plus speakers for bringing their thought leadership to our program. For today's webinar, we will be using the On24 platform. Right now, you should be viewing the On24 dashboard, which shows the live viewing screen. During the webcast, all participants will be in listen-only mode. Today's presentation is slated for approximately 45 minutes, with 15 minutes at the end for questions. Our panel of speakers will be taking questions throughout the session via the Questions widget. Please type in questions during the presentation and click Submit. If your question is of immediate import or concerns technical problems, you will receive an immediate answer by text. You can also find a widget entitled Resources, where you can download assets provided by the speakers and sponsors for each webinar. Just click the resource in the box and it will be automatically downloaded. If you are interested in receiving CLE or CE accreditation for this program, you must stay on for the full duration of the webinar and answer 3 polling questions that will appear during the course of the program. Additionally, please fill out the participant information questions. This will ensure that you are correctly matched to the state and professional organization. As a reminder, this webcast is being recorded. After the presentation, you will receive an archive link for further review or for sharing. The webinar will also be available for future viewing on our website. Again, thank you for joining the Net Diligence Virtual Cyber Risk Summit. We hope you enjoy the program.
Hello, and welcome to Net Diligence. Today is the discussion of non-affirmative cyber. My name is Bob Parisi. I'm the Marsh Cyber Product Leader, and I'll be your moderator for the discussion today. Joining me is Michael Hauner from Munich Re, Max Perkins from Axis, and Scott Goodies from Barnes and Thornburg. Before we get started, though, however, we're going to basically do a quick test. We've got 3 polling questions today, so we're going to jump in and start the presentation and discussion with the first polling question. And the first polling question is, true or false, it is estimated that the malware NotPetya cost more than $10 billion in damage. True or false? I'll give you folks 20 seconds to submit your answers, and then we'll move on. This is to increase your anticipation of all the exciting stuff we're going to be talking about in, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right, moving on. So the agenda for today is we're going to look at a couple of definitions just to set some groundwork as to what non-affirmative cyber is, some coverage considerations, as well as product development and solutions. We're going to start with a quick discussion to lay the groundwork as to silent cyber, non-affirmative cyber, and we'll basically walk through that in about 3 to 4 minutes, and then we'll jump into the good stuff, the panel discussion, which is going to range fairly far afield. It's a little different. We're not just going to basically walk through this is CGL, this is property. We're going to try and make this as interesting as possible and discuss real applications for brokers and underwriters as they look at how the world has changed in the wake of the Lloyd's mandate. But first, quickly, we just need to figure out, well, what is cyber risk? And you would think that's a fairly obvious question and everyone would understand that, but it's probably a good idea just to set something down. The way we define cyber risk for this discussion is it's the possibility of loss or injury relating to or involving data or technology. Data and technology can be lots of things. Historically, when people think of cyber risk, they jump right to privacy, and when they jump right to that privacy, they think just about personally identifiable information. What we've seen, though, is that it's any factual and confidential information, and it doesn't have to be just simply, health records or payment card information. It can be corporate information. It can be trade secrets. It can be processes and procedures. It doesn't have to be just privacy. And what we've seen in particular in the last couple of years, and that first question about NotPetya alluded to it, is that technology goes well beyond things revolving around e-commerce or .com or websites. It deals with operational technology, SCADA systems, large companies manufacturing things. All are dependent upon technology. So it's that reliance or use of data, it's that reliance or use of technology that creates cyber risk. Okay, so moving forward, what is silent cyber? What is non-affirmative cyber? And I'll give you a hint. There's a polling question that asked this very question. So you're getting the answer. It's like a take-home test that all of our kids have been dealing with since the pandemic. So silent or non-affirmative cyber, we're talking about the potential cyber exposures with traditional property and liability insurance policies that may not implicitly include or exclude the coverage. So what that means is you can have an insurance policy triggered when cyber events as triggers for loss are not included or excluded. You've got exclusionary language that may be ambiguous. You may have express cyber grants that are ambiguous in and of themselves, all of which create a bit of a confusion as to where cyber risk, especially physical cyber, which is bodily injury and property damage resulting from cyber events, failure of technology and that sort, where is that properly residing? So why is this an issue, though? Well, it's an issue for a bunch of reasons. Obviously there's a concern as to where this coverage should reside generally, but starting a couple of years ago, Lloyd's and the UK regulators made it a pretty express issue. In January of 19, the PRA instructed insurers to have action plans. In July of 19, Lloyd issued a market bulletin, otherwise referred to colloquially as the Lloyd's mandate, that required all policies to be clear on coverage for losses caused by cyber events. That contained a, let's say, problematic or controversial definition of what cyber risk is, and we'll talk a little bit about that today because it bifurcated, some might say arbitrarily, what cyber risk is into two buckets, one being malicious, one being negligent, and made a distinction. We've had the European Insurance and Occupational Pension Authority likely to issue a similar directive, and we've got a Lloyd's market that now has set out a phased schedule, which I'll talk a second, that lays out very clearly when all the different lines associated with Lloyd's underwriters have to be compliant with that Lloyd's mandate. Okay, so the question is, and we're going to talk a lot about this in the panel, how are insurers complying with this silent cyber mandate? Well, there are really four ways we're seeing that compliance happen, and in many ways, most property and casualty carriers are landing on one or two of these. The first is you can affirm all physical cyber exposures within policy regardless of technology. That's kind of the broker's dream. That's not what we're seeing, unfortunately. You can see policies that are affirming all physical cyber exposure, but it's sublimited. Some of that is happening now. You've got the third option, just excluding all cyber exposures. Doesn't matter what happened. Doesn't matter if there's an intervening physical cause. If somewhere along the line there was a keystroke, it's excluded. You've got the fourth and final ways is excluding all cyber exposures, but then inserting certain buybacks for ensuing losses, saying, look, it's not covered, but we'll cover fire or explosion if it's from a negligent act as opposed to a malicious act. And that's where we get into the controversy as to bifurcating what a cyber risk is. So what does that mean for policyholders, and what does that mean for carriers that are governed by Lloyd's? Well, the Lloyd's timetable as of January 2020 is that there are 4 phases. The first phase was largely associated with direct loss property, saying that as of January 2020, they had to be express, i.e. not silent, on how they were handling cyber risk. Phase 2, we've got policies incepting after July 2020. Phase 3 is January 1 of 2021. And by July of January 2021, everybody that's governed by Lloyd's has to be in compliance with the mandate. Again, the mandate doesn't tell you whether you have to cover it or not cover it. It just says you have to be express as to what you're doing. Okay, so now we move on to our next polling question. Okay, so we've got our second polling question. True or false, silent cyber and non-affirmative cyber are the same thing. Hopefully you were paying attention, and this should be a pretty easy question. So I'll let this run for a little less than the full official 20 seconds. And this way we can jump right into the panel discussion. So here we go. Panelists, I hope you guys are ready. Michael, I'm gonna start with you, and we'll see what Munich Re's thoughts are about this issue. Michael, what about cyber non-physical damage? To which line should this belong? Where should we sit this coverage?
Yeah, Bob. Thanks for having me. So, with regard to that question, I can and I want to be very clear here. Munich Re believes that all BI which is triggered by cyber and is not having a physical damage to tangible property somewhere in the chain of causation, that this BI should clearly belong to cyber. And I can give you the reasons. So typically BI is a product of property, and property and the property product is an all-risk product. So you would say, let's throw it in there. However, and for quite a while now, cyber emerged as a new risk on the landscape, and the majority of the property market, in our view, has not developed the skill set and ability to assess IT risks properly. So the cyber market, however, has. And we strongly believe that it should reside with the line that has the best knowledge and expertise about it. So skill set is definitely one argument. Another one, maybe the most important, is the systemic nature of the risk. And with cyber exposure emerging, there's a new dimension of accumulation loss potential. And frankly speaking, that just would not be digestible in the property market with the high limits there. And finally, maybe if you allow a very brief comment on breaking, as it's an issue close to it and very topical at the moment. This exposure does not include any physical loss or damage to the substance of property, and hence we clearly consider the cyber market to be the best owner of this kind of exposure.
So Michael, if I can interrupt, just to clarify, when we talk about BI, we mean business interruption, not bodily injury. So in case anyone was
correct.
got sidetracked, Can you mentioned bricking? Can just for the audience, in case someone's out there, can you just tell us what you mean by bricking?
Yeah. So what I mean by bricking is, in case there is some devices got infected by a virus, there is no change to the substance or no physical damage to the device. However, the device is bricked, so you can no longer use it. That's what I mean by bricking. And typically, what you do then, in many cases, is much more easy to buy actually a new device rather than to reinstall all the software again. And maybe to finish this off, in the past, this exposure is sometimes covered under property, limited, but we believe, as there's no really there's no really physical damage to it, that this exposure should be handled by cyber, as they do understand the attack vectors much better.
So, Michael, as someone who makes his living selling cyber, I'm certainly not going to disagree with you, but we'll see what Max and Scott think. Max, just jumping into it and kind of playing off what some of what Michael said. Clarity of coverage across an insurance portfolio is critical. You may recall that from your time as a broker. In your new role as an insurer, how can you identify and understand risk associated with non-affirmative cyber? Isn't this a little like trying to understand all things in the universe?
It's a good question, Bob, and it is very tough. It's open-ended, but the answer in my mind, and this kind of comes back to the time I spent as a broker and seeing the partnership that needs to develop between the companies who are looking to transfer the risk, who have the risk at hand, and then the insurance companies who are going to take it. And it's really that ability for the underwriter to understand the business, have access to information around the exposures that exist. For example, not all manufacturers are created the same. None of them have the same technology systems, whether it be corporate or industrial control systems, operational technology, et cetera, which create these exposures to what we've been, what we call non-affirmative cyber. And we need to try to get our arms around it. Now, I realize that's probably an impossible task for all of us to try to tackle for hopefully, one day the millions and millions of buyers of cyber insurance. If we can have these conversations, if it's that I think you very well outlined earlier around, as Lloyd's put out there, trying to be clear. It's not about whether, somebody should or shouldn't accept the risk. It's about being clear as to whether you are or are not doing it. And we're trying to do our best where that is concerned as insurers, or at least I hope I say that and represent that fairly across my colleagues in the underwriting side of the industry.
Great. In a fair panel, the next question would be for Scott, but we're going to go back to Michael. So, Michael, there's still a lot of remaining cyber as a covered peril in traditional lines of business, property and casualty. There are going to be times when cyber events are in that chain of causation. What should we be doing with that? Should we be leaving it? Should we be excluding it? The mandate just says we have to be express. It doesn't give guidance as to where it should or should not reside.
Right, and let's assume some of that stays in property or casualty. Probably we won't manage to get all into cyber. First, we have to understand what type of cyber exposure still remains. And I can assure you, this is not a trivial question and not a trivial exercise. We have to analyze the wordings closely, that's for sure. It's not only about the wordings themselves. Further to that, the industries and occupancies, as Max already alluded to, of the risks play a role too. And there are occupancies around that are much more prone to cyber than others. And if you now are focusing on property for a moment, if there is still non-physical damage, BI, business interruption exposure remaining, then we strongly suggest to tackle this exposure similarly to BI exposure in standalone cyber products. And that would mean, with the help and the expertise of a cyber underwriter, the exposure has to be properly assessed, underwritten, and priced for. And of course, and I want to add this most importantly, we have to be certain to get the accumulation management right, to take care of systemic risks in an adequate way. And the basis for this is obviously the availability of information, and of course that might be a challenge. Maybe a last sentence on cyber-triggered PD, if I may. We shouldn't neglect or ignore this exposure. And also there, our standpoint is that there has to be a proper assessment on whether or not cyber is changing the exposure landscape. And this proper risk assessment and pricing is certainly still in its infancy. As I feel that the market phase we are in at the moment is still having its focus on lying awareness in the topic. But as an industry, we have to closely monitor exposure developments in order to avoid any surprises here. And there are trends which might change the exposure landscape.
Yeah, so it's interesting. It's only in insurance do we talk about a product that's been around for 21 years as still being in its infancy. I think I agree with you. It's in its infancy relative to actuarial data. I think one of the things we're seeing with a lot of the fintechs and the infotechs, the insurtechs, is trying to bring in the data that's out there and have it be usable for the carriers to help them underwrite this. So it is interesting that the data's out there, it's just not in a way that traditionally we've seen carriers have it. Scott, we've talked a lot about clarity and how this, silent cyber is all about getting clarity. It's going to be a while before all the policies are clear one way or the other. So we're going to be dealing with, at least for the short term, situations where one event might have, might trigger coverage under multiple policies. There's that pesky other insurance clause. How should we be looking at that when it comes to silent cyber events?
It's something that always surprises me when I'm actually dealing with this in practice versus dealing with this at past net diligence events. In that, at past net diligence events, people have said to me, I was crazy, I was taking food out of their mouths by suggesting that policies other than cyber insurance can provide coverage for cyber or data privacy-based risks. And then I've had multiple events in which I've worked with people who are handling the claims at the insurance carriers, whether it be outside counsel or in-house claim adjusters. And invariably, I've had cyber adjusters say, well, this really is not our problem. Have you talked with, for example, the professional liability carrier? Have you talked with the crime carrier? Have you talked with the kidnap, ransom, extortion carrier? And I've had situations in which the cyber carrier says, we're not first, that you should look to the other policies. Their policy is primary. It's not ours. And so after being told over and over again that I was crazy for suggesting that there's coverage in other policies when it comes to events where we're all gathered together to talk about the latest and greatest in terms of the world of cyber and data privacy, then at the time of a claim, I'm told, well, why would you look to me for the cyber policy? I've got another insurance clause. It applies second. So it's a challenge for a policyholder because not only is it make for a reasonable joke as the world of insurance goes, in a reasonable story. But the challenge, again, if you are the corporate policyholder, you're dealing with an event, and from your perspective, you have policies that either lack clarity or seem straightforward in providing coverage and not excluding coverage, and then you're told that 1 + 1 = 0 because rather than having two policies to cover, you're having a discussion about which carrier provides coverage first. It's a frustrating situation to be in, as you might imagine, when you want to have your claim paid and you've got carrier saying, well, not me because of my other insurance clause.
So Scott, just to clarify, so the audience is not confused, those are two separate discussions you mentioned. The first discussion was people telling you were crazy, and then the people talking about you taking their food out of their mouth. So those were two very different discussion threads. But let me ask you this: what's been my experience has been that we've avoided trying to have a solution to the other insurance clause, which is pretty much boilerplate at this point. And it's just been a kind of solemnic split the baby, right? It's like, all right, both policies apply, 2 deductibles, off we go, and you get both limits, but you're also run 2 deductibles. Is the solution maybe a new other insurance clause that just takes into consideration the fact that, there might be a property coverage, or do we look to some other wording maybe that just says other valid and collectible?
In a perfect world, it would operate more along the lines of the carriers pay at the same time, and in the idea that when there's overlapping coverage, they share. With usually that backup clause you see sometimes in a general liability policy talking about sharing of the risks if there's or some other means like that, and that would be ideal. And the alternative, it can behoove a policyholder to drill down when you're at the time of purchase, which I know is a challenge because undoubtedly policyholders have programs that all renew at once. And so we have the luxury of sitting back at a seminar and saying, well, if you talk with your carrier at the time you're buying and you had a discussion about how the other insurance clauses work, that would be great if you weren't in the situation where you're renewing comp and property and general liability and lots of other policies at once. But in a perfect world, it would be an other insurance clause that is reflective of what coverages are overlapping, where do the deductibles and retentions fall, and how could you make it so that you've made a determination as to which carrier will provide coverage first, and whether whether the underwriter would agree to say that, yes, I'm going to be the lead, I'm going to be primary. And again, I've even had that situation where in having discussions with a policyholder who was renewing and was focused on the other insurance, I had a cyber carrier emphatically say to the policyholder that the underwriter would not provide primary coverage in the cyber policy, and that had the expectation that the professional liability line would provide coverage first, and fought against that. It fought against the idea that the cyber policy provided first layer and first dollar of coverage. And so it's, Bob, you're right that in a perfect world we would have it where it says everybody gets on board, or the cyber policy provides first layer, first dollar of coverage. But in practice, I haven't seen a real willingness for people to say, we'll write that into our policy and we'll provide it in that way.
So Bob and Scott,
yeah.
I was going to say, it's Max. I just want to jump in there and say, Scott, I agree with you, and I would, my colleagues on the underwriting side might hate me for saying this, but I agree with you, and I think that discussion should be had, especially on, bespoke large accounts. We should be open and willing to having the discussion so that we have the cards organized up front at the time of placement and at the time of agreeing to the policy. It's hard to do it on a blanket basis across a portfolio if we're talking about large swaths of volume business, kind of in smaller startup organizations or smaller middle market. But I do think it should be addressed, and in it. You make a good point, Scott, and I agree with also that underwriter. I know that you might have disagreed with them and that I think certain professional liability policies should step in first, because that's probably the point, the cause of the issue, and probably the policy that should have responded first. But there's certainly other situations where cyber should be primary. So I'll stop there, Bob, but I thought that might be important or helpful, and again, a challenge to all of us on the underwriting side to step up and have these conversations.
No, I find myself in the odd position of agreeing with you, Max. I think.
Who would have thought we'd have all three of us?
Yeah, no. Michael. I'm guessing Michael will come in and say something. He'll disagree with us, but I do think. My background, came as a coverage attorney, as an underwriter, and now as a broker. I never was comfortable with ambiguity as a strategy. Exclude it, include it, just be upfront about what you're doing. I think the problem comes in that, Max and Michael, you guys might be express as to what you're doing in the Munich Re policy and the Access policy, but you've got no control over what a property market's doing, or a casualty, or an energy market. So And I think this is where the silent cyber mandate does have some validity, and does add some value in that it attempts to get the market writ large all singing from the same hymnal. It doesn't mean if access is expressed, that's great, we love it. But if you have XYZ property policy being ambiguous, so now we've created we're still stuck with another insurance clause, or a dispute as to where it's covered or not covered. So let's we're not going to solve that one today, but let's kind of move on. And this is, Michael, I'm going to ask you to kind of talk about this. Historically, in the cyber insurance discussion, the debate was system failure versus security failure. So was it a general failure of technology, or was there a hacker? We've now, the Lloyd's wording is part of their mandate, basically created a malfeasance, misfeasance distinction. So something that the cyber market has walked away from. Is it should we be making a difference between whether or not the technology failed because it failed, or because it was hacked into? And putting aside for the moment that attribution is a really tough thing from a factual perspective.
Yeah, that's an interesting question, and you mentioned it. On the property side, when thinking about property exclusions, this distinction has been made for a long time. For example, CL 380 only excluded malicious acts. But I believe that the thinking in property in the past was along the lines that predominantly, if not only, malicious attacks can lead to systemic events. Like for example, a self-propagating virus. And now with increasing digitization of the economy, I think this no longer holds true. So you will have non-malicious systemic events that are much more prominent. So this is one aspect why I don't think we should make a difference here. A second one is certainly, and I think you alluded to it, I don't think it's practicable to distinguish in reality. You will likely run into troubles finding out whether or not an act was malicious, and the result will likely be high effort and cost through hiring forensics companies, for example, and in the end, you might still end up having some uncertainty. And maybe giving you a last aspect here, if I put myself in the shoes of the client, I would want all cyber being covered in one policy, and not having some covered in, for example, property and others in affirmative cyber. And as Scott and Max alluded to this earlier, you might run into troubles with gaps and overlaps, just increases complexity and ambiguity, and that's certainly not in Munich Re's interest. So I'm fully in line with Scott and
I have a
Max
different
here.
opinion. I have a slightly different opinion on whether we can find attribution. I think where there is an issue out there, and I know all of us are aware of these, implementations of system upgrades or new systems and integrations, they go wrong all the time. And I certainly, can understand and certainly did represent on behalf of clients as a broker wanting to make sure that we dealt with that risk, whether we understood it through the contractual process back to the system integrators and the consultants involved and made sure that their insurance would step in, or whether we could get the coverage out of the cyber market. But what I can tell you as an underwriter, and I think, Michael, you'd appreciate this too, is that we have to try to make sure that we're going to be sustainable over time. And those are the types of system failure issues that I question whether they're going to be sustainable. I think there are a lot of them that maybe claims haven't been reported because people didn't know they could. And that's the one part that I disagree with you there on, Michael, and question whether that should be included in this type of coverage for non-physical business interruption. Kind of throw that out there.
Yeah, I mean, with regard to system failure coverage on the cyber side, it is, I mean, there are various forms of coverage, like the open peril coverage you probably refer to, the named perils coverage. Yeah, it's certainly tough to tackle it, but if you handle it, then you should handle it on the cyber side and not on the property side.
Oh, I see what you mean. Well, in that I do agree. I just don't know if on the cyber side we have the appetite to actually do it well, because I think it's a really tough risk.
Absolutely. I think we could do another full session on this.
Could I jump in on this as well?
Yeah.
I think one of the things that Michael said was pretty important, was the takeaway of where do policyholders, the clients of the insurance carriers, where do they view this risk? And from the perspective of a policyholder, I think you'd be pretty hard-pressed, unless someone had been through an event and had some discussion with the carriers, of saying, well, when I'm buying a cyber insurance policy or any other policy that could provide me with coverage for some kind of damage as a result of a cyber event, that they would say, well, but I fully expect this will only work if it's a denial of service attack that takes me out, versus we had some kind of catastrophic failure when somebody made a mistake. And so I understand where Max is coming from, is wanting to be certain that the industry will be around after a significant event. But conceptually, if insurance has, insurance claim attorneys have said that really insurance is around for negligence and non-intentional conduct, how different is that from an IT person making a mistake, or somebody screwing up with an upgrade or with system maintenance or something along those lines, and then the system goes down? So you're actually not the victim of a malicious criminal attack, but you are victimized by negligence or something along those lines. And having been at an organization where the explanation was there was something that failed, there was a system failure of an email system where we were without our email for a week, it was pretty devastating. And so conceptually, if as a buyer, you'd say to yourself, well, I don't have any expectation that in that context I would get insurance. It's only if I'm the victim of an attack that's of a certain kind and of a certain nature. From the buyer's perspective, it's a tough spot to be in, and I know that the expectation of many is that they'll have that coverage, and I can't certainly square how the underwriters view it as to their books, but from the viewpoint of what they think that they're getting when they're buying it, I think that most understand and expect that they would have coverage for both situations or both causes.
Well,
yeah, no,
Scott,
I think you're. Go ahead, Max.
I was going to say, great point, Scott, and I can't completely disagree with you. I think you're right. I'm talking about the sustainability, and maybe I need to, further think through that and talk about the fact that there are other levers to pull, as in pricing and retention, and making sure that that, if it's a risk that we can identify and get comfortable with, that we're at least doing it in a way that is sustainable and that we can all come together and buy it in that way. And then also recognizing that in cyber, this is where subrogation comes into play. And subrogation, Bob can probably speak to this more, or maybe you, Scott, that, we're all seeing much more subrogation now than in the, call it 10 years, 15 years of this cyber insurance industry. And so maybe that is exactly where it begins to play out. And again, taking it off the client.
I want to keep moving because we do have some other questions we want to get to. But I think one of the things we need to remember is cyber is by and large a property and casualty-esque risk. For a long time it was treated as if it was professional liability, but that was more the anachronism of just happened to reside in the in the financial lines or professional liability section of carriers. To the extent that cyber provides property and casualty risks like business interruption, like damage to information assets, we do a disservice when we go into our clients and say, well, this is essentially the property portion of cyber, and then it looks and feels dramatically different mechanically from property. And, without going down the road too far, the cyber market for the longest time had a very odd way of dealing with deductibles and a very odd way of dealing with, things like contingent business interruption that were, not the same as how property dealt with business interruption and contingent business interruption. So I think the question becomes, in some ways, what does cyber want to be? If it wants to fill the gaps that clients have in their risk, then it's going to have to address things like system failure. If it wants to go down the road, and I think it's already gone down that the road of being the solution. I think if we start going back down the road of making a huge distinction between, well, maybe you'll get system failure, maybe you won't, it's a step back at a time when more people are looking at technology as a key source of risk. So, moderator's privilege. Moving on. Scott, just a real-world question. Ransomware continues for, I don't know how many years in a row now, to be one of the biggest perils or threats that companies are facing. Which policies are responding to these ransomware attacks and losses?
Mm-hmm. So cyber is the first place that policyholders look, that I look, and you have the expectation it will be in there. And then the question is, was the policy providing you with cyber extortion coverage, and what does that mean? And did the policyholder buy, did the carrier sell business interruption coverage as well for the purposes of the lost income during the downtime, in addition to just dealing with, but dealing with the ransom payment, if that's the avenue down which you decide to proceed. Then beyond that, kidnap, ransom, and extortion policies have provided coverage, particularly when it comes to decisions to pay the ransom and the ransom payment. I've had crime policies respond in certain circumstances, and even first-party property policies. Without getting into the argument of the National Ink and Stitch case out of Maryland, a decision that I think is great, but beyond that, there are property policies that have sometimes small, sometimes reasonably sized pockets of coverage where there's not really any argument in terms of the coverage applying, so that it might be some kind of malicious vandalism or electronic vandalism or some other name like along those lines. And that varies by policy, but I've had carriers in the property space step up and say, okay, you have this, here's a quick check for your $10,000. And I've had others say, okay, they have a $250,000 pocket of coverage there. And after examining some of the bills, they cut a check and paid under there. So there's cyber, again, as the expectation that would be your lead place, but multiple other policies will will step in. And sometimes it's the carriers and the underwriters and the claim adjusters step up and say, okay, we're going to pay them, we're going to cut you a check. Other times when it's a situation where you're dealing with a question of, is there physical damage and there's not that pocket of coverage, or some other argument along the lines of whether it's there's damage to tangible property, courts step in and tell the carriers that that's what they need to cover.
Okay. So, Max, I was going to tee up the next question for you, but you kind of weighed in and almost semi-answered it. So I'm gonna basically ask Michael a question, and I will ask you to kind of chime in at after Michael answers, because I do want to get into now the discussion around underwriting. Michael, can reinsurance be a solution to this silent cyber problem, or is it just a short-term problem? Is that silent cyber fact that gets a property casualty treaty over the hump? Is it the 8-track tape of reinsurance? And that's a reference that only people as old as the panelists will actually get.
Yeah. Thanks very much for the question. And can reinsurance be the solution? Well, we have seen those coverage grants for silent cyber also on the treaty side, and by the way, we call them sleep easy covers. We don't believe those covers are sustainable, as there's just no transparency on the underlying silent exposure. It's silent. How would the reinsurance industry be able to assess those treaties? So we question the sustainability. Certainly, the problem arises at the insurer, the silent cyber problem. He needs to solve it by finding a sustainable solution, and not simply transferring the exposure to the reinsurance market to circumvent the problem. Of course, we as a reinsurer and a reliable partner, we do help our clients in finding solutions, and we accompany them on the way to transfer the silent cyber exposure into affirmative. And we've also built up resources to manage this, and that includes developing potential loss scenarios, developing the legal expertise and the risk assessment, and finally also the accumulation process and accumulation management. So in short, and to summarize, if there is cyber exposure out there, then this cyber exposure needs to be made affirmative, to be properly underwritten, assessed, and measured, and finally priced for.
Great.
That would be my take here.
Thanks, Michael. So we're starting to bump up on the question and answer section, but I did want to get one question in, and I think it's been running through, or the issue's been running through the discussion, both in the lead-in and what we've been talking about. And Max, I'm going to ask you to kind of lead off the answer on this one. So it's a bit of a multi-pronged one, but bear with me. So there are going to be challenges that exist for carriers to offer that complete solution to the market as property and casualty markets retreat from offering cyber coverage. There's going to be that challenge. Do the underwriters are you getting access to the information you need to be able to properly evaluate these risks and offer coverage?
Excellent question, Bob. Thank you. The answer is across the board, no. I don't think we're getting access to the information from all clients and prospective buyers. Except
Marsh clients. Let's just caveat.
Except for Marsh clients, of course. Yeah, exactly. Okay. And I will say, what I will say is that I think that is what is there to separate and differentiate the brokers and the brokerage community. And credit to you, Bob. I've seen submissions from all the different brokers out there, and they're not identical. There's no uniformity to it. And a lot of it is honestly demonstrating the ability of the brokerage community to communicate with their colleagues across the different lines of business to submit the property, the cargo marine, stock throughput, submissions along with what is thought of as the traditional cyber submission in order for the cyber underwriter to take a view over whether they'll take on those additional risks that we're talking about in terms of property damage and potentially bodily injury and certainly non-affirmative business interruption. And then I would highlight just one other challenge that I know you were just talking a little bit with Michael about, and that's really building the capital. And that requires, we spend a lot of time at Access on research and having, folks who are not actually talking with our insureds just to try to help us to make sure that we're understanding all areas of risk as it pertains to whatever cyber means. And then the other is building out that reinsurance portfolios to support the ability to offer capital. And that's really big. And I'm not afraid to say that and share that with our colleagues, competitors in the market, because I think we're all in this together. And I think, Scott or Michael, you might have mentioned it earlier that, the cyber market doesn't have the capacity that the property market has. And I think unless we all do this, we're never going to have that capacity to be able to fully offer a complete solution. And that is a challenge.
So that's an interest. Michael, if I could just jump in and ask another question. Max, do you think there's a need to bring that capital in and bring the cyber market capacity up to a place where you can have someone buy, $1 billion or $2 billion of cyber insurance?
I think with respect to covering property damage, yes. I don't think all buyers of the data breach coverages, Bob, that we've all been working on since early 2000s is there in a need apart from a couple large financial institutions. But okay. I do think, having had some conversations with some big manufacturers, they're basically saying, look, you're saying you can cover property damage. It's great to have a lead-in of $50 million, but I'd buy $1 billion. And your risk, to a point Michael made earlier, within our organization, it can be systemic. So we have to think about not just losing one property to a fire, but potentially multiple at one time.
Absolutely.
So, Michael, I cut you off. I'm going to let you have the last word before we move into the question and answer phase.
No, I'm good. Actually, Max already pointed it out. You have to think of the systemic risk in there, and that's, I think, the biggest challenge in increasing the cyber capacity here.
So, all right, excellent. So hopefully, I would have a follow-up question on how truly systemic it is, but hopefully someone in the audience will help me out and ask that question. We're going to move on to our last polling question now before we go to live question and answers. But I want to thank the panel for what I think was a very lively and forthright discussion. Thank you, gentlemen.
Thanks, Bob.
Thank you.
Okay. The last and final polling question before we open it up and take your questions. Is silent cyber getting louder? I did not write that question, but we'll see what the answer is. You can say yes, you can say no, or you could say you're just generally unsure. So we'll let that go for 20 seconds, and then we'll move right into question and answers. Gentlemen, that was a great discussion. Thank you. I'm just looking at the questions that have been submitted, and one jumps out at me. So I'm going to basically throw that out for the limited time we've got left, and let's see what we get. So the question was, what if there's an intervening covered cause between the cyber event, the keystroke, and either the property damage or the stock drop or what have you? You've got you've got an HVAC event that then causes a fire, and the fire burns down the building. Can you look back up the chain of causation and say that it's a cyber event and not a fire? So, Max, I'm going to throw that, let you kick it off. What do you say to that?
Well, it's not easy is the answer. This is where I think that, one of the items we haven't talked about today and that we don't talk about often enough is how we're going to manage the claims and identifying the proximate cause and ultimately going back to whether there was a cyber trigger or not. How are we going to coordinate, coordinate that claims management side, especially with folks in the cyber groups who are typically used to either some sort of litigation claims, financial loss claims, and they're suddenly looking at property damage or some sort of marine loss in cargo, which has then gone missing. And so I think all of this, I just say all of that, Bob, because I think this is where the challenge lies. And I think the way that you described that situation, we hope that there are some forensics there, that there are some logs that are stored off-site that might give us a clue as to whether that peril that began the whole chain was cyber or not. And if not, then I think we got to look to unfortunately may end up getting to the folks like Scott who then need to push and pull in the legal world to help the insurers to allocate the loss and hopefully make the insured whole. I'm going to stop at that. Hopefully it helps.
Yeah. So Scott, help me out so I don't have to jump in on this one. Isn't a fire though?
Mm-hmm. Right. So when you think about a property policy, you think about an all-risk type of coverage. And so if there's a fire and that's the direct cause of the loss, then I would expect a carrier that provided the property coverage to cover it. And to take that a step further, carriers pretty frequently argue that if there are too many steps removed between what they view as the original cause and then the actual loss that the policyholder suffers, they say it's not direct loss or it's too far removed, too far down the chain. And so if the fire is a physical type of trigger that is covered under an all-risk policy, from my perspective, then the fire should be covered under the property policy.
Yeah, and maybe right. I can add to this, Bob, if you allow.
Yeah.
So I very much see it similar to Scott. Although, currently you see some exclusions in the market coming up, which do try to exclude everything which is triggered by cyber, and that might change the picture going forward. But so far, the character of a property policy is always to cover physical damage to the substance of property. If there's no explicit exclusion that prevents this, then I see coverage here.
Okay, and in the minute we've got left, one of the other issues, I'll leave it with you, Michael, with the last question. Is it appropriate to think of cyber risk as the true aggregation menace that the property and casualty folks think of?
We very much believe that there is a huge potential cyber accumulation there, and we very much assess and measure the systemic risk and take care of it by using our internal models and our internal resources, as well as vendor models. And as you know, there are quite some vendor models around that are also trying to get their arms around the systemic side of the risk. Certainly, we're looking at some key scenarios. Think about a major cloud outage or self-propagating virus or something like that. So yes, it's a huge systemic risk.
All right, gentlemen, thank you very much. This has been very interesting for me. We're running down. I apologize to the attendees that we had such a short question and answer period. I hope we were able to get to your questions in writing during the session. I want to thank Net Diligence for the opportunity and the panelists for their time and their effort. Thank you all very much. I'm going to have a little bit of dead air.